If every country in the world is in debt, then who exactly is being paid? Pause on that question for a moment. Governments owe trillions. Headlines warn of unsustainable debt. Economists argue over deficits. Politicians promise to pay it back. But step back and look at the full picture, and something feels deeply wrong. Because debt, by definition, requires a creditor. Someone on the other side of the ledger. Someone who is owed. So if the United States is in debt, and Europe is in debt, and China is in debt, and Japan is in debt, and developing nations are drowning in debt, who holds the world's IOU? Is there a hidden owner of global debt, silent lender behind the curtain? Or is the entire system built on a contradiction we're not supposed to notice? Today we're going to follow the money slowly, carefully, and chronologically, till the answer becomes unavoidable. And when it does, it may change how you think about money, power, and sovereignty forever. If this video helped you see the system more clearly, share it. These conversations matter more than ever. Subscribe for deeper breakdowns of power, money, and hidden structures shaping our world. Debt itself is not new. Ancient civilizations borrowed grain, silver, and labor. Kings funded wars by promising future taxes. Empires rose and fell on credit long before modern banks existed. But historically, debt had limits. A king could only borrow what lenders believed he could repay through conquest or taxation. Too much debt meant default, rebellion, or collapse. The system enforced discipline through pain. That changed in the 20th century. The turning point came with industrial-scale war, global trade, and most importantly, modern central banking. Governments needed vast sums of money quickly. Gold and silver were too restrictive. Taxation was too slow, so a new solution emerged. Sovereign debt issued in national currencies, backed not by metal, but by trust. Trust in governments, trust in institutions, trust that tomorrow's economy would always be bigger than today's. After World War II, this system hardened into global architecture. The Bretton Woods institutions, the IMF, and World Bank standardized sovereign borrowing. The US dollar became the world's reserve currency. Debt was no longer a temporary tool, it became the engine of growth itself. But here's the twist most people miss. Once money itself became debt, the question of who owes whom stopped being simple and started becoming philosophical. And that's where the real story begins. Modern money is not created the way most people imagine. Governments do not simply earn money before spending it. In most systems, new money is created when debt is created. When a government issues bonds, those bonds are purchased often by banks or central banks, and new money enters circulation. In other words, debt doesn't follow money. Money follows debt. This is crucial. When a government runs a deficit, it issues bonds. Those bonds are assets to whoever holds them, and liabilities to the state. But at the global level, those assets and liabilities start to overlap. Countries hold each other's debt. Central banks hold foreign reserves in the form of bonds. Pension funds, insurance companies, and sovereign wealth funds hold government debt as safe assets. The system becomes circular. Japan owes debt primarily to itself. The US owes debt to domestic institutions, foreign governments, and its own central bank. China holds US debt, but also issues massive debt internally. Europe owes Europe. There is no single vault where the world's debt payments accumulate. Instead, debt becomes a web interlinked, self-referential, and increasingly abstract. And for decades, it worked. Growth covered the interest. Inflation stayed manageable. Faith in the system held, until it didn't. From the 1980s onward, global debt began to accelerate faster than economic growth. Governments discovered that borrowing was politically easier than taxation. Central banks learned they could suppress interest rates to make debt appear harmless. Financial markets demanded more safe assets, which meant more government bonds. Each crisis reinforced the pattern. A recession hit, borrow more. Banking collapse, borrow more. A pandemic, borrow more. Debt was no longer a temporary bridge, it became permanent infrastructure. By the early 2020s, global debt exceeded 3 times the size of the world economy. Not household debt, not corporate debt, total debt. And yet, despite this staggering number, defaults did not arrive, at least not at the scale many predicted. Why? Because central banks stepped in as buyers of last resort. They created money to buy government debt, pushing interest rates down and stabilizing markets. This process, known as quantitative easing, blurred the line between creditor and debtor even further. When a central bank buys its own government's debt, who is the creditor? The state owes itself. The interest circulates back. The debt never truly disappears, but it never fully demands repayment either. This is where the illusion becomes complete. Every system has a constraint. For debt-based money, that constraint is confidence. As long as people believe the currency will retain value, the system holds. But when inflation accelerates, when living standards stagnate, when productivity no longer justifies the borrowing, the cracks appear. Interest payments begin to crowd out public spending. Governments borrow to service existing debt. Central banks face impossible choices: raise rates and trigger defaults, or keep rates low and fuel inflation. This is not theoretical. It is happening now. We see it in currency crises, in austerity measures, in social unrest, in declining trust in institutions. And suddenly, the original question becomes unavoidable again. If every country is in debt, who's the creditor? The uncomfortable answer is this: there isn't one in the traditional sense. The true creditors of the global debt system are not nations. They are time, productivity, and the future population. Debt is a claim on future labor, on future taxes, on future economic output that has not yet been created. When governments borrow endlessly, they are pulling purchasing power forward from people who have not yet voted, worked, or even been born. This is why the system persists without a clear external creditor. The bill is always deferred, but deferred does not mean erased. The cost shows up as slower growth, higher inequality, asset bubbles, and declining opportunity. It shows up in younger generations working harder for less purchasing power. It shows up in political instability and radicalization. The creditor is abstract, but the consequences are not. Governments have tried everything. Austerity fails because it crushes growth. Inflation erodes debt, but destroys trust. Default resets the ledger, but collapses systems. Financial repression hides the problem, but worsens inequality. Each fix treats the symptom, not the cause, because the cause is structural. A global economy addicted to debt-based money in a finite world. This has happened before. Ancient Rome debased its currency. Medieval kingdoms rolled over war debts indefinitely. Weimar Germany printed to escape obligations. Different eras, same logic, same ending. What's different today is scale. Never before has the entire planet been inside the same debt system at the same time. There is no outside reset. So what do we take from all this? First, global debt is not owed to a secret elite, it is owed to the future. Second, a system that requires endless growth to survive will eventually collide with reality. Third, understanding money is no longer optional. It is a survival skill. The open question is not whether the system will change, but how and who will bear the cost. Will it be controlled reform or chaotic correction? That decision is being made quietly every day. And remember, the most dangerous illusions are the ones that feel normal. Guess when everyone is in debt? The real creditor is time, and it always collects. Thanks for watching and support.